Most people think markets panic when something bad happens. They don't. Markets panic when something quiet shifts in the background and the crowd hasn't caught up yet. Right now, headlines are loud. Everyone's watching the same stories, reacting to the same alerts, scrolling through the same takes. That's usually not where the real risk lives. When fear is obvious, it's already late. When everyone is pointing at the same problem, it's rarely the surprise. Here's the uncomfortable truth most investors don't like to hear. By the time you feel anxious enough to ask whether you should get out, the market has already made its first move. Not because it's smarter, but because it moves before narratives solidify. This is where people get trapped. They assume volatility equals danger. They assume uncertainty equals chaos. They assume bad news automatically means lower prices. History doesn't support that assumption nearly as often as people think. What actually matters is what changed beneath the surface, not what's trending on your screen today. Liquidity shifts before prices. Policy expectations move before headlines. Large capital positions itself long before retail investors feel emotional pressure. So if you're looking at the market right now and thinking, this feels risky, that's not a signal. It's a prompt to slow down and ask a better question. What has the market already adjusted for, and what is it still ignoring? That's where real analysis starts. Over the past several months, the cryptocurrency market has already undergone a meaningful repricing. From recent local highs, total market capitalization declined sharply, with several large-cap digital assets correcting between 50% and 70% from their peaks. This move unfolded gradually rather than through a single liquidation event, indicating distribution over time rather than panic selling. During that same period, volatility increased in short bursts, particularly around macroeconomic announcements and geopolitical developments. These moves were uneven, sharp intraday reactions followed by stabilization, rather than the sustained, cascading declines typically associated with systemic stress. At the macro level, interest rate expectations shifted multiple times. Earlier optimism around sustained rate cuts softened as inflation data came in mixed. Headline inflation continued to trend lower compared to prior years, but progress slowed. Core measures showed persistence, particularly in energy-sensitive components. This altered the timeline, not the direction, of monetary easing expectations. In parallel, energy markets experienced renewed price pressure. Oil prices moved higher over a compressed time window, driven by supply route uncertainty rather than demand expansion. The speed of the move mattered more than the level. Rapid repricing in energy filtered into short-term inflation expectations without yet translating into confirmed, broad-based inflation data. Importantly, none of this happened in isolation. Bond yields adjusted first, especially at the front end of the curve. The US dollar strengthened modestly, reflecting defensive positioning rather than capital flight. Equity markets showed rotation rather than collapse, with capital moving toward cash flow stability instead of exiting risk entirely. In crypto specifically, derivatives markets reflected declining leverage. Open interest fell alongside price, suggesting positions were closed rather than forcibly liquidated. Funding rates normalized. Spot volumes remained active, but did not show signs of capitulation. Compared to last month, prices are lower, leverage is reduced, and expectations are more conservative. Compared to last week, the market is less reactive to headlines. The speed of downside movement has slowed, even as uncertainty remains elevated. These are observable conditions. No interpretation is required to confirm them. They describe where the market stands, not where it's going. What matters here isn't the headline event itself. Markets rarely move on the event. They move on the secondary consequences, the things that quietly change incentives, behavior, and constraints. Start with energy. When oil prices move sharply, the first-order effect is obvious: higher input costs. But markets don't stop there. Energy feeds transportation, manufacturing, and logistics. That pushes expectations, not necessarily prices yet, around future inflation. Expectations are enough to alter positioning. Once inflation expectations shift, even modestly, rate expectations follow. Not because central banks react immediately, but because capital prices in what might restrict policy flexibility. The market doesn't need confirmation, it just needs reduced certainty. That alone tightens financial conditions at the margin. Now layer crypto on top of that. Crypto doesn't compete with oil, it competes with liquidity. When rates are expected to fall, Liquidity has somewhere to go. When rates are expected to stay higher for longer, liquidity becomes selective. It doesn't disappear, it concentrates. That's the second order effect most people miss. This environment doesn't automatically mean risk off. It means risk filtered. Capital doesn't exit markets wholesale. It rotates toward assets with clearer narratives, stronger balance sheets, or more institutional relevance. In crypto, that means differentiation increases. Broad rallies stall. Relative performance matters more than absolute price. There's also a timing mismatch worth understanding. Energy reprices quickly, inflation data updates slowly, policy reacts even slower. Markets live in that gap. That's why you can see pressure without collapse, weakness without panic, and volatility without resolution. Another subtle but critical effect is leverage behavior. When uncertainty rises, leverage is the first thing to go, not conviction. Traders reduce exposure before long-term holders change views. That's why you often see open interest decline ahead of price stabilization. It's not fear, it's risk management. Who feels this first? Short-term participants, high-frequency strategies, leverage positions. Who feels it last? Long-term capital that moves on policy clarity, not price noise. This is why interpreting every macro shock as immediately bearish misses the point. The real question isn't whether conditions are good or bad, it's whether they are becoming more restrictive or less predictable. Those are not the same thing, and markets price them differently. Understanding that distinction changes how you react. Instead of asking, is this bad for crypto? The better question becomes, which assumptions just became less reliable, and who is forced to adjust because of that? That's where cause turns into consequence. Periods like this feel rare when you're inside them. They never are. If you step back and look across market history, you'll find plenty of moments where prices weakened not because something broke, but because assumptions were being renegotiated. The market wasn't collapsing, it was recalibrating. One useful comparison is not the crisis itself, but the months before one was either confirmed or avoided. Think about prior cycles where inflation surprised to the upside after appearing contained, or where energy prices spiked due to supply risk rather than demand strength. In those windows, markets didn't immediately trend. They stalled, they chopped, they frustrated both bulls and bears. What mattered in those moments wasn't the shock. It was whether the shock forced policymakers to abandon a trajectory. When policy paths stayed intact, markets eventually stabilized and moved higher. When they didn't, repricing continued until expectations matched reality. Another recurring pattern, major uncertainty tends to surface after extended drawdowns, not before them. By the time the dominant narrative becomes, this could get ugly, positioning is often already defensive. Risk has been reduced. Leverage has been trimmed. That doesn't guarantee upside, but it does change the asymmetry. What's different this time is structure, not emotion. Markets today are faster, more global, and more reflexive. Information travels instantly, but decision-making still doesn't. That gap creates noise. It amplifies short-term reactions without necessarily changing long-term outcomes. It's also worth noting what hasn't happened yet. In past episodes that turned genuinely bearish, you saw disorder, funding stress, forced selling, correlation spikes across all assets. Those conditions preceded deeper damage. Their absence doesn't mean safety, but it does mean the system isn't under visible strain. History isn't a blueprint. It doesn't tell you what will happen next. What it does do is remind you that markets often look their worst when they are transitioning from uncertainty to clarity, not when they are actually breaking. That distinction matters, because reacting emotionally to similar moments without recognizing what's different is how investors turn temporary discomfort into permanent mistakes. History doesn't repeat outcomes. It repeats patterns of behavior. Understanding that is how you keep perspective when narratives feel overwhelming. At this point, certainty is a liability. The only responsible way to think forward is in scenarios, not predictions, not convictions, not narratives that require being right. Markets don't reward certainty in unstable environments. They reward preparation. So instead of asking what will happen, the better question is, what would need to happen for each path to unfold? Let's walk through that. Bull case, pressure dissipates, liquidity reasserts. This scenario doesn't require perfect outcomes. It requires containment. If energy prices stabilize after an initial spike, even at elevated levels, inflation expectations can remain anchored. In that case, central banks don't need to reverse course, only delay. A pause is very different from a pivot back to tightening. If that happens, financial conditions stop worsening. Liquidity doesn't surge, but it stops retreating. Markets can function again without fighting the policy backdrop. In crypto, this would likely show up first as relative strength rather than broad rallies. Assets with institutional relevance, regulatory clarity, or real settlement use would attract capital before speculative segments do. Volatility compresses, downside tails shrink. Importantly, this case doesn't assume optimism. It assumes the absence of escalation. That alone is often enough to shift markets from defense to patience. Base case, extended uncertainty, no structural break. This is the least exciting path, and historically the most common. In this scenario, energy remains volatile, inflation data stays mixed, and policy messaging becomes cautious rather than decisive. Rate cuts are delayed, not canceled. Financial conditions remain tight, but not tightening further. Markets don't trend strongly in either direction. Instead, they oscillate. Rallies fade. Sell-offs find buyers. Time does more damage to weak positioning than price does. For crypto, this environment favors discipline. Leverage remains low. Narratives lose power. Performance gaps widen between assets with substance and those driven purely by sentiment. This is where impatience becomes the biggest risk. Not drawdowns, time. Investors who overtrade or chase confirmation get worn down. Those who manage exposure and wait for resolution preserve optionality. Nothing breaks here. Nothing explodes upward either. It's uncomfortable but stable. Bear case, policy path breaks. This is the scenario that would matter. If energy-driven inflation feeds directly into core measures and stays there, policymakers lose flexibility. If inflation expectations de-anchor, rate cuts come off the table entirely. In that case, markets have to reprice duration, risk, and liquidity all at once. That's when correlations rise. That's when differentiation fails temporarily. That's when even strong assets get sold. Not because they're weak, but because capital needs to reduce exposure. For crypto, this would mean further downside pressure, especially in assets that rely on liquidity rather than fundamentals. It wouldn't be subtle. You'd see it in yields, the dollar, and funding markets before crypto reacts fully. The key point: this scenario requires confirmation, not headlines. It doesn't happen quietly. Professional investors don't bet on one scenario. They prepare for all three and adjust as probabilities shift. Right now, probabilities are moving, but none have collapsed to zero. That's the difference between risk and fear. When conditions are unstable, opinions don't help. Indicators do. Not because they predict the future, but because they show pressure building before it becomes obvious in price. The first thing I watch is the US dollar index, not the level, the behavior. A grinding rise tells you capital is seeking safety. A sharp spike tells you stress is spreading. Right now, the dollar matters because it reflects global demand for liquidity. If the dollar strengthens alongside rising yields, risk assets struggle. If the dollar stabilizes while yields stop climbing, pressure eases. Next are treasury yields, especially the front end. Short-term yields move on policy expectations, not emotion. If they continue to rise, markets are pricing tighter conditions. If they flatten or roll over, it signals that policy constraints are becoming less binding. I care far more about direction than absolute numbers. Inflation data comes after that, not headlines but components. CPI and PCE matter less in aggregate and more in what's driving them. Energy-driven moves that don't bleed into services are noise. When they do bleed through, they change everything. That distinction takes time to confirm, which is why reacting early is often a mistake. Within crypto, I watch liquidity and leverage. Open interest tells you whether risk is being added or removed. Rising prices with falling leverage are constructive. Falling prices with collapsing leverage are cleansing. Volume matters too. Not spikes, but consistency. Sustained participation tells you capital hasn't left, even if it's cautious. Positioning is the last piece. When consensus leans heavily in one direction, outcomes skew the other way. That doesn't mean fading sentiment blindly. It means respecting asymmetry. Markets hurt the most people possible, most of the time. None of these indicators work alone. Together, they form a framework. They don't eliminate uncertainty, but they prevent emotional decisions masquerading as analysis. That's the goal, not certainty, control. When markets feel unstable, the instinct is to do something. Trade, react, reduce discomfort. Most long-term damage happens right there. Not during the volatility itself, but in the decisions made to escape it. Nothing about the current environment requires panic. It requires discipline. Risk isn't the presence of uncertainty. Risk is acting as if uncertainty demands immediate answers. It doesn't. Markets move in phases. They absorb information, misprice it, correct, and move on, often long before narratives catch up. The job isn't to predict the next headline. It's to stay solvent, stay patient, and stay aligned with what actually drives capital flows. Manage exposure. Respect time. Let probabilities evolve before committing to conclusions. I'm not trying to convince you that everything is fine. I'm saying it's knowable, observable, and manageable if you focus on process instead of emotion. This isn't investment advice. It's simply how I'm reading the market right now, calmly, cautiously, and with a long-term lens. That's usually enough.